Okay. All right, so everybody joining, pop in the chat where you're from, where you're joining from, your name, and we're going to kick things off very shortly. Yeah. All right, so as you're coming in, hello Finamisers, welcome to another Finamise Live. My name is Luke, your Finamise analyst, and I'm hosting today's event on Investing 101, the DIY investor, with our partner IG Investment. First, you have a few housekeeping rules to run through those, so feel free to introduce yourself in the chat. As I mentioned earlier, tell us where you're tuning in from, and remember to switch to all attendees so everyone can see your messages. This is a 15-minute conversation followed by a 15-minute audience Q&A. Use the Q&A box to ask a question, and if you see a question you like, this is a democracy, upvoted, so it moves to the top. That way we can get through the most upvoted questions first. Okay, let's kick this off. Our event partner for today is a leading retail trading and investment platform, IG. If you don't already know, IG provides ambitious, self-directed individuals with the products, technology, and insights they need to access opportunities in financial markets. And they've been doing this since 1974, long time before I was born, that's for sure. We'll drop a link in the chat box now so you can learn more about them and have a little read. Quick disclaimer before we begin, your capital is at risk. 76% of retail investor accounts lose money when trading spread bets and CFDs with this provider. You should consider whether you understand how spread bets and CFDs work and whether you can afford to take the high risk of losing your money. Today, I'm joined by IG's chief market analyst, the captain at the ship over there, Chris Beecham. How are you doing today, Chris?
I'm not bad. Thank you very much. It's been, it's busy week, busy couple of weeks actually, but I think we're keeping on top of things.
Yes, markets have been certainly interesting. We got Apple results out later tonight. We had the Fed last night, and today, in a few minutes, we have the ECB. So lots for traders, investors sink their teeth into. Well, you know what? We quite pressed for time, so let's dive straight into the questions. So Chris, I'm going to kick things off with, in my personal journey, I feel like the majority of effort and focus goes into returns and not enough on understanding robust risk management. Why is this so important for investors, do you think?
It's the classic thing, isn't it, really? Everyone focuses on, well, it's a human nature, I suppose. Everyone focuses on how much money you want to make, and the great investors are defined by their returns. But those returns only really come if you can manage the downside, really. And it's understandable. Again, human nature. No one wants to say if you place this trade, if you do this investment, how much money could you lose? But it's almost the better way to think about it. Which is why you should define, okay, if you're using a stop loss, then you say, well, this is how much I'm prepared to lose in the trade. What's my downside? Because ultimately, what really catches out most people is their risk management discipline and the fact they often lose more money than they make. Even though, and we find this across a lot of IG clients, the data's there to see on the website, which is a great thing. But what we find is a lot of our clients win more trades than they lose, if we put it that way. But they still lose money because they tend to, as we see, they tend to run their losses and they cut their winners, because everyone likes taking a profit. You close out a trade, you close out an investment, a small win, but you don't look at the big losers you've had. But what defines great investors, and certainly successful investors, not even spectacularly great ones, but just successful investors, is their ability to focus on the slightly duller, more pedestrian element of risk and how to manage that risk rather than constantly chasing the high returns. Because of course, with the potential for high returns comes the potential for big risk as well.
Exactly. And you mentioned stop losses, but what are some other maybe strategies, methods, or rules investors, traders can implement to guard against those large drawdowns and large losses?
Well, over trading is always another one, because you end up taking a series of losses and you find yourself you try not to trade everything. Really, I think that's the temptation with trading and investing, is you sort of dabble in a bit of everything, because of course the great thing about investing these days is that you've got so much choice on offer, so many markets, so many shares, so many ETFs to choose from. but that means you often end up chasing investments across the board. So you sort of lose track of what's going on. You end up placing lots and lots of trades, and without sort of cutting back on the amount you're risking per trade. If you're trading one market, then you could argue for. I talk about most of what I say is talk about trading because that's where most of our clients are leveraged. But investment, the same rules apply. If you say I don't want to risk for investing, say 5% of my capital on this investment, but if you're placing sort of 6 or 7 different investments, if you're putting them on, then you want to reduce the amount of capital you're allocating to each one, so that if they all go against you, and sometimes they just do, then you don't end up losing as much money. So that's another way of doing it, is to try and narrow your focus. Really, that's another good one. And I think just knowing why you got into something in the first place, particularly I think for investing, because obviously investors are taught you should buy things when they're cheap and sell them when they're expensive. But the problem is usually when things, stocks can be argued to be cheap, sometimes there's a reason for why they're cheap or they end up getting cheaper. And you need to sort of review your investments on a regular basis to say, why did I buy this? Is it still relevant? Is it still going up? Is the sort of thesis still there that got me into it in the first place? Really, those are the kind of things you want to be asking yourself. That constant self-examination, again, not the easiest thing to do, but it's a very important process, I think, for investors.
Yeah, I think that's really important what you mentioned about, especially if you've got multiple trades on and you're risking 2 to 5% per trade, and even if they're correlated, like if you're trading petrocurrencies or oil stocks, then that becomes even a higher risk. So I think that's a really important point you raised there, Chris. But that leads me to my next question, where you were talking about, sort of really knowing why you're getting into a trade. Do you think it's a good idea to keep a trading, investing in journal to learn and improve on your investing journey?
It is really. It's hard. Again, a lot of these things we come across require you to be quite disciplined and keep a record of say why you put the investment on, why you placed the trade, what was the rationale, what was the strategy behind it, if you're using a target, what's your target, what's your stop loss, and there of course the concept of risk reward comes into play. So you should be looking to try and sort of make what we call a 2-to-1, 3-to-1 risk to reward ratio for starters. But yeah, journal's vital, because then you can look back and see where you were successful or where you were less successful, your good trades and your bad trades. And it's important, almost more important, to remember your bad ones than the good ones. Everyone remembers the good ones. People don't want to remember the bad ones, but you can look back and see, this one didn't work. And keep a record of why they worked and why they didn't work, and say, well, the thesis was okay, but the market moved against me for whatever reason, or yes, I did place that trade for the wrong reasons, that kind of thing. So you can look back and try and improve, because of course this should be a process. It should be an ongoing learning process, really, as well.
100%. And I think it depends, obviously, how granular you get in that journal. You can probably discover which is the best asset class that you're trading. It could be FX, stocks, indices, what time of the day, European morning, that sort of stuff. So yeah, I think there's definitely a lot of useful and valuable data you can glean from keeping a record. It is a bit cumbersome, but I think if you want to take this seriously, it's a good process to put in place. Just for anybody that didn't know what a stop loss was, it's basically an automated order that you can put in with your broker or on the trading platform that gets you out at a predetermined level and locks you in at a predetermined loss if the trade moves against you. So if you're short selling and you put a stop loss above the price, if it went higher, that would get you out, and if you're long, below, obviously. Just want to announce that to our audience. Chris, what are some of the different investment styles, strategies to be aware of? So sort of maybe more passive, just buying and holding an index versus more active single stocks, diversification versus sort of concentration risk, I suppose, when you're investing in single stocks versus buying an index.
Well, this is the thing, isn't it, really? It's horses for courses, things, different ways of appeal to different people. The risk, of course, is with single stocks. If you don't put too much on a single stock and hope it will outperform, spread your risk around. Now, usually, I think the benefits of diversification are perhaps oversold sometimes. I think people say you should have lots of stocks in your portfolio to diversify against the possibility that some will turn against you. I think with diversification, you can sort of go too far. Last check up on the data, it says if you've got more than sort of 15 to 20 stocks in a portfolio, the benefits tend to diminish quite dramatically after that, really. A lot of fund managers have lots of stocks in a portfolio, so they're not running practically a mini index, and that doesn't really seem to get you anywhere. But if you're looking, obviously, the index gives you a broader range. Different indexes have different compositions. Obviously, you've got the NASDAQ, which is tech, whereas if you look at the FTSE, it's focused more on banks and miners. So they will have different performances. Although, again, they tend to move roughly in the same direction with some variation across the board. Clearly, some indices have outperformed massively, particularly the US and the NASDAQ over the past 10 years. Aside from that, it's about a question of looking at whether you want to go for value, trying to find stocks that are viewed as cheaper, or going for growth, stocks with maybe a higher earnings growth rate, or income stocks as well, ones with dividends, which can appeal. And in all cases, there are good ways to do that and bad ways. And I think for dividends, perhaps most obviously, you end up, a lot of people end up chasing just the high-paying dividend stocks, regardless of the factors behind why there's a high yield on that. So if you look at a stock and it's paying you 15-16% in dividend yield, you should be asking yourself, it's an extreme example, but you should be asking yourself, why is that the case? It's usually a red flag for that kind of high dividend yield. But those are the kind of strategies you can employ when you're starting out investing.
Okay, and then I suppose for those that I've seen a question actually come through too, so it was one of my questions, so it'll be useful that we're answering one of them too. How much capital should, if someone wants to dive into the trading world and sort of segment trading versus investing, how much capital should one be allocating from their overall investment portfolio to more tactical opportunities and trading?
With that, it tends to be about probably 5 to 10% at most. I think 10% would certainly be the outlier. Trading is a different mindset to an extent, and obviously you're using probably leverage rather than investing it. So there is the potential there for both the big gains and the big losses that come quickly. With trading, it's often viewed as a bit more of a tactical thing. You can jump in and maybe you can look at hedging to an extent, is the way some people approach it. They say, well, I use my trading account to maybe short an index in periods of market declines, and the investment account is for just holding and letting it rise over time. So that's the way people look at it. But I think it's around 5 to 10%, and probably more towards 5% really, particularly, of course, for the beginners.
Yeah, I think that's a good number, Chris. Chris, technical analysis, it gets a bit of a bad rap sometimes in the investment world. What's your take on it? I personally think it should be in an investor's toolbox. A good golfer can't just drive; he's got to be able to putt, chip, and everything. So, what's your take, Chris?
Yeah, it does get a bad rap. I think a lot of people look at it and say it's voodoo. It's just looking at charts and drawing pretty lines and hoping that it's an attempt to try and predict the future. It's really not, I think. And I got a couple of qualified technical analysts, IG, or more than a couple really. And I have to sort of be careful how I say this, but I think it is often abused more than it's used properly, because people assume that it will give you some kind of peek into the future and the indicators are some sort of holy grail. I think proper technical analysis is merely just saying these are the levels that are important. So it is handy, though, I think, fundamentally, because I've seen presentations from fund managers where they obviously, most of them don't use technical analysis, although some of them do. And they talk about an investment. I remember one particular presentation, I think it was on Tullow Oil. It was when the years when Tullow was going down. And the fund manager was busy telling us how much he liked Tullow Oil, but with the chart of the stock behind him, you thought, well, it's going down and down and down. I mean, at what point do you stop liking a stock that's continuing to fall? So I think if you can combine the fundamentals and the technicals, then you give yourself the extra edge. Yes, there should be a compelling value when you're investing, particularly, it should be a compelling thesis, but also ultimately you buy what's going up and you sell what's going down. I think if you can simplify it to that degree, then it does sort of help to eliminate you doing the thing where you're constantly buying stocks just because they're getting cheap and because they're still falling. And if the price is rising, it's usually a sign that the market thinks there's something right about it, and that gives you an extra sort of boost to your trading when you're investing.
Great, Chris. We've got 2 more questions and we're going to move into the Q&A. So you've been in this game a long time. What's your process when you try and construct an investment thesis or trade idea? Like, what do you go through? Just give us some insights into how that works.
I always look, when I'm looking at, I do actually start at the point of looking at the longer term charts. for an investment. Even when I'm putting in my SIP, I think if you can find, and here we're not using daily charts, we're talking about weeklies or monthlies. If you've got a weekly or monthly chart that's rising, that's a good sign. There's a sign that there's strength in that stock price, I think, and that the fundamentals tend to back you up from there. Really, when I write pieces, I always look at the stock price first to sort of get a sense of where thinking about this stock. And then you do want to look for things that aren't too expensive. I think I would always go for the P of sort of between 5 and 15, depending on the sector, but it's a good place to start, really. And then if it's got a dividend yield, certainly that's so much better. And that you can apply that to ETFs as well. I think you can say, look, what's the chart look like? Is there a compelling reason to invest in emerging markets to an extent? For example, what's the rationale behind it? But I certainly do start actually with the chart and say, is it going up or down, or where do we go from there? And then you can look at the fundamentals, I think, really.
Great. And for those starting out, it obviously can be quite overwhelming and chaotic with the amount of info out there. So, where's the best place to begin in terms of resource and tools? I think RG has some analysis and resources, doesn't it, Chris?
Yes, we do have. We have a section on the website devoted to analysis, looking at major news. We talk about indices, we talk about stocks and the major FX pairs. So it's a good place to start. There is a huge amount of data on there, out there that you can read, and you can watch videos on YouTube. And getting a sense really of what's moving in the financial press is also always vital, I think, really. And learning how to do your own research is particularly important, rather than trying to constantly chase down things. So starting out reading things like The Intelligent Investor is always good, as how I started out, really. It's a good grounding point to try and look at things in a sensible and careful way. And then you've got the financial press as well. And that gives you a good background on what's moving in the news, really. And then go from there. But whatever you do, I think it's important, whether it's fundamentals or technicals, it's important not to overcomplicate it, really. A lot of people start out and they make things very, very complicated, and they talk about complicated metrics and lots of different indicators. And I think they just end up, tying themselves in knots over investments, really. There's a certain argument for keeping things relatively simple, whether it's the charts you use or the metrics you look at, really. So it is possible to go too far, for most people anyway, really.
Chris, that brings to an end our introductory questions. We're going to hop into the Q&A now to get you over what the people want to know. So one of the most upvoted questions so far has been, we sort of answered already. Jack asked, how do you consider allocation if you want to buy and hold while also trade? So I think you said 5 to 10% earlier, basically. And that sort of answered that question. Then we've got another one that's been upvoted quite a bit. Whilst I've made long-term investments, I have very little experience in trading. How much money should I set aside to get started? Thanks.
That's always the rough rule of thumb, I think, is about 1 to 2,000 if you've got that kind of money to available. Really, you can do it with 500, but often the sort of position sizes you require, or the amount of margin required, particularly for retail investors, means that you've got to have a reasonable amount in your account to start with, just so you've got that sufficient margin on offer, really. So that's kind of the level we're looking at, really, I think, for most beginners, or for a lot of ordinary retail investors, if you like.
Okay. All right. And then Marco asks, I consider myself a semi-experienced investor. I probably update my portfolio 4 to 5 times a month, but definitely looking to diversify with trading. Seems like a learning journey, though. Sorry, that's a Finimize. Does Finimize have a masterclass for that? I think we do have a pack, and we can send that on to you, Marco. TJ, how do you determine what's a good stop loss level? It wouldn't be great to sell too quickly. Is there a good rule of thumb?
With stop losses, most people are very bad at stop loss placement, I always think. They put it too close, really, and then you get this thing of people saying, well, the market's moving against me and they can see my stops and this kind of thing. The way most people think of trading is they think, well, I want to place a trade at a certain amount per point, and then I work out my stop loss from there. Whereas you should be looking at it the other way around. You work out where to put your stop loss, and then your position size is determined by that, really. Certainly most people do put their stop losses too close, and they forget the markets go through volatile periods and quieter periods, and you can to account for that. Really, should be able to see that on the chart. If the price is swinging around madly, then there's a sign that this is a bumpy ride, to put it mildly, and that you should be widening out your stops. You can look, if you're using, say, 10 analysis and you're trend following, you can place your stop sort of below the previous low that you're looking at, if it's an uptrend, or above the previous high if it's a downtrend, that kind of thing. But most, I think, try and always put them relatively wide, really, is the best way to look at it, because most people do fundamentally just put their stops too close, and they forget the markets can have these big intraday swings. Or, for example, if they're trading the Dow, they tend to maybe put their stop 50 or 100 points away, and then you forget the Dow can move that kind of distance very, very quickly, stop you out without sort of changing the overall direction. I think that's the kind of lesson we have from stops, is you need to tailor them to the volatility of the market you're trading, and understand that, that these things can move very quickly in a short space of time, and that keeping a tight stop may not necessarily be the best way to approach it.
Yeah, I mean, I can't imagine anything frustrating if you get the direction right, but you get stopped out on a quick intraday swing. And I think it's important, you can actually widen that stop and keep your risk per trade the same by just decreasing your position size slightly. So you widen the stop out, keep your position size slightly smaller, and you're risking the same amount. So that's an important point to make, for sure. So Chris, any YouTube channels or websites you recommend or utilize a lot for developing your methodology and deepening your knowledge? That's come through from Jay.
Well, it for me, because I'm sort of have to do this for a day job anyway, I kind of absorb myself anyway in things like Bloomberg and Financial Times and Reuters. For deepening knowledge, I think, to be honest, Finimize is a good place to start as well. And then you've got things like TradingView, investing.com have good tools on offer, really, just to keep updated with what's moving in markets. I don't tend to watch too much on YouTube, to be honest with you, in terms of trading, but there's so much out there. A lot of stuff in IG as well, in terms of trading, in terms of trade ideas, or looking at education. Those are good places to start, really. And good areas for people to sort of get a good handle for how they're trading. And whatever you do, I think you should start slowly, really, and work up to these things, because it's all too easy, I think, to get wrapped up in trading. And then before you know it, you're placing lots and lots of trades. You've no idea really what's going on. You've not really got a proper handle on it. So just always start small and pick a single market and try and learn your risk tolerance more than anything else, really. I think it's a process that everyone has to go through. What kind of risk are they comfortable with? And you rapidly find that out if you're using too large a position size, how risk can move against you. So it's an important lesson to learn, is your own risk tolerance.
I think that's so important, that what you mentioned there, discovering it, and that's why demo accounts can be so useful. Sort of implementing strategy first before using real money, getting the process and the logistics of actual trading and investing down pat first. Ramona wants to know, what are the most popular trades on IG right now? I suppose by volume size, maybe, Chris, something like that.
Yeah, for right now, I think as ever, it is primarily our main focus is indices. About sort of 40% of our monthly trades is indices, by volume and by activity. Simply because I think people, they're familiar with them, if you like. They understand how they move. They see them reported in the news, and there's a sense of you can take a position of view on something relatively easy with an index. So those are our most popular markets in terms of actual client activity. The most popular ones being the tech 100, the NASDAQ 100, and the Dow. I do think the large numbers on the Dow do tend to appeal to a lot of people, because you get these big swings. But again, people know what indices are, they understand them to an extent. And then if you're looking at the rest, it's something like euro dollar, it's gold. And then in terms of shares, the most popular at the moment are things like Tesla and Amazon and Apple, which, to be honest with you, rank in the top 10 every single month without fail, actually. Again, because people recognize the names. Tesla's and used are not for good reasons and bad. Amazon, everyone understands it, and Apple. I think there's a popular shares. They do have decent movement. There's also plenty of volume in them as well. So that for people particularly starting out in investing and trading, the volume is quite good. If you're in the small caps and in stocks that don't move very much, it's obviously not interesting from a price movement standpoint, but also there's not very much volume, so you get big movements on on little bits of news, whereas things like Amazon and Apple and Barclays and Lloyds and BP, other big ones this month, there's plenty of volume and plenty of activity, and there is plenty of news flow as well.
Great. Thanks for that, answering that question, Chris. We've got David and Jack who've asked sort of a similar one, so I'm going to group it. And it's sort of asking, should you start with one market or asset class when you're learning to trade, or should you split it across multiple markets and trade sort of multiple instruments?
No, I think you start with one, definitely. And usually you stay with one or two. A lot of our successful clients stay with one or two markets. They don't try and trade. We've got 16,000 markets on the platform. Clearly, very few people have tried them all, really. And it's just, I always say to new clients, just because you've got these markets on offer doesn't mean you have to trade them. I think the best way to learn is that to understand trading is to pick one market and stick with it. Because it cuts down the number of trades that you can do, because otherwise you're always just chasing off and doing FX or commodities or whatever kind of obscure stocks and obscure commodities. And B, because I think you have to know the market you're trading in terms of its mood, in terms of what news flow there is. If you're trading with FTSE, it is affected to an extent by economic data in the UK, but also in the US. So you need to know what time things are coming out. If, as we were saying earlier, if you start to spread around and you're trading a bit of indices and maybe the euro and gold and soybeans and whatever, you need to know when this kind of data comes out, and you'll rapidly find that your attention is just spread far too thin, and then you end up missing things or not knowing why things have moved. So the best people, I think, concentrate and focus. And to digress slightly, this is where, I don't know if anyone's seen Clarkson's Farm on Amazon Prime, but I was watching it, and strange person that I am, I thought actually there's a lesson for traders here, because if you watch Jeremy Clarkson starting his farm, he starts to do something different every week. In 1 week he has sheep, and 1 week he has chickens, and 1 week he does something else. You think that's exactly what a lot of our traders do, actually. They go and trade something else every single week or every single day, and they don't really know what they're doing. They haven't bothered to understand it before they get stuck in. I just think that's often the way, that because people are looking for the move or they're looking for something different, you end up sort of just not giving anything enough time to work. And you often see that with markets. Markets go through periods when you can trade them quite well, or you feel like you know what they're doing, and other times where they just don't want to behave. And particularly if you're looking for decent trends and you want to move of 3, 4, 5, 6%, whatever, markets won't do that all the time. Sometimes they will just consolidate and go sideways, and it can be frustrating. And that's when people get bored and they wander off and try different things, and that can be a bit of a problem, I think, for new traders.
That's where the range trading the support and resistance comes in, like the S&P at the moment, and oil actually has been in quite a nice range. Chris, we've got another question here from Amarcha saying, how do you find out companies that are going to make some profit, and is day trading better or sit on it for a longer time like Lifetime?
So if we want to break that one down into two questions, so we think of that.
Yeah, I think that's a good idea.
So if we're looking at companies that you expected to grow, you have to look at their earnings. If I understand the question correctly, you're looking at their earnings and seeing where the improvement is, and things like their bottom line, essentially, and their margins. That's always a good one to keep an eye on, is their profit margins. That's essentially, stock prices are a reflection of future earnings. So if someone's earnings are improving, it's likely that over time their stock price will continue to go up. So that, as an investor, is something you want to look for, is that their earnings are rising. What was the second half? I've forgotten now.
No worries. The second half was, and is day trading better or sit on it for a longer time like Lifetime? So buy and hold.
Well, this is the $65,000 question, is it really? I think for most people out there, and I say that most maybe in inverted commas slightly, but usually it's better to take the longer term view, not necessarily just to blindly buy and hold, but certainly to give things time to work in your favor, I think. And that's important with investing, that you're not a professional fund manager. You don't have to report your performance quarterly to a board or whatever. You can let things work. And sometimes you can buy a stock that's in an uptrend, for example, or it's got good earnings, and then the stock doesn't seem to react for a while, but over the course of 2 or 3 years, it can go up. And the most unexpected stocks make huge gains. I think I remember looking a while ago, or quite some time ago now, when US railroads were in the picture. There was takeover talk in the sector, and looking at the long-term chart, there's huge gains available there. Even something like AstraZeneca, talking about it last week, we looked at the price chart, and the return, including dividends, which as a long-term investor is crucial. If you include dividends, the long-term picture is sort of 15% annualized return over the last 12 years. I'm not saying that's going to keep happening, but for a slightly, it's a pharma company, it's not known to be the most exciting in the world, but that's a really, really solid return. So for most people, I think the longer term works. Even for day trading, though, I think trading is always seen as a very, very short-term thing. It doesn't have to be. I think if you're looking for the moves of, say, a couple of months maybe, then you can take the position that way as well, rather than simply assuming that you have to be trading it on a short-term chart and jumping in at the beginning of the day and closing out at the end of the day.
I think, Chris, just to end off with going back to that question about, sticking with one market or two markets, ones that you know well, how does one choose which market would be best suited for them? Is it a cost thing, like the ones with the tightest spread, so cheapest to trade? Is it something that's not as volatile? Maybe, like, how do you suggest maybe narrowing it down to find which is that best instrument to trade?
Yeah, I think you want things that are less volatile, that are relatively liquid, so where the spreads are narrow. So that is a good way to look at it, rather than pursuing, say, small cap stocks where there are quite wide spreads. And you are looking at, maybe it's why indices are so popular, because the spreads are so narrow, and there's plenty of activity. So that's a good place to start. But just to remember that, yes, just because something's really volatile, it's not always the best way to look at it, really. And then if you look at also things that you know about, really, that you've got an interest in. So I think that's why, again, as I say, people tend to trade mostly indices with us, and then mostly euro dollar and cable, pound against the dollar, and then gold and oil, because they understand them to an extent. And as it was, the name of the fund manager escapes me, but they said you should invest and trade in what you know, really, and what you understand. And that's an important principle, I think, to apply.
Yeah, I think that's actually very true. I wouldn't personally trade lean hog futures. So that's, I think, a perfect example of something that I would have absolutely no idea about trading, and I think I would blow up my account very shortly. Chris, thanks. That's all we have time for today. But thanks for joining us. I found it very insightful, and I'm sure the audience has too. I hope it's been enlightening, informative. And yeah, thanks for joining, Chris, and chatting to us.
Thank you. It's a pleasure.
Cheers.